how much time has to pass before we know whether an investment manager is skilled or lucky? Well, this is a question that Rubin Miller asked and says that we should ask potential financial advisors if we're thinking about hiring them, or investment managers. Well, it's a function of two things. It's a function of how volatile that excess return is. If a manager consistently outperforms year in and year out, then it takes less time to determine whether they're skilled or lucky. The other thing is, well, how much is that outperformance? If the outperformance is larger, then it takes less time. Now, we can put that into a formula to give some examples. Here they are. This is from an article, The Information Ratio, that came out in the Financial Analyst Journal in 1998. And I won't get into the details of the formula, but we'll just go through some examples. If a manager has a 1% excess return, the tracking error is 3%, then it would take 35 years before we can say, yeah, that outperformance is due to skill rather than luck. If that excess return was 2%, then it would only take 9 years if the tracking error was 3%. But if the tracking error was 6%, again, we're up to 35 years. And finally, if the tracking error was 10%, but the excess return was only 1%, it would take 384 years to determine whether that advisor or that investment manager was successful. So it really depends, and that's why we need to understand, well, how volatile is that excess return and how large has the excess return been?